Hello, everyone, and welcome to our State of the Market update for January 2023. We want to wish you a happy New Year's, happy holidays. We're going to jump right into it today. Don't forget to drop us a quick like and subscribe. We're going to go ahead and provide some chapters through this if you'd like to bounce through, make it a little bit easier for you.
Today, we're going to be talking about mortgage rates, home price updates, inventory, also markets in the Bay Area, Lake Tahoe, and pulse of the market. So starting with rates, the 30-year fixed rate in this country doubled over the last year. We started out at 3.2% back in January, just a year ago, and ended up right at 6.4% as we wrapped up the year. We've never seen a year like that in mortgage rate doubling, and we've never seen as rapid a rise in mortgage rates in this country. All of that certainly has impacted the market. We talked about that last month and really broke down the relationship between the 30-year fixed mortgage rate and the 10-year Treasury yield. If you remember, we talked about the spread. We went through the examples of why are rates not at 5.5%. And if you go back to year 2000 through 2021, really the past 21 years, and we see the average 10-year Treasury was at 3.49%. The spread there was 1.79%, giving us an average mortgage rate of 5.28%. So you take the Treasury, you add 1.79%, and you get the average mortgage rate. And that average over the last 20 years has been 1.79%. And then we talked about how over the last couple of years that's fluctuated, but certainly in the last year, we've seen that spread rise, where today the 10-year Treasury at 3.69% and the spread at 2.79%, giving mortgage rates right now, as of the most recent posting from Freddie Mac, 6.48%. So let's call that 6.5%. So the spread has widened over the past year.
Here would be my message right now. The spread between the 10-year Treasury and the 30-year fixed is a measure of volatility and panic. The panic is starting to subside. That's good news for long-term interest rates. We've seen a little bit of relief over the last 6 to 7 weeks and a couple chip ups in the last few weeks, but certainly an up and down, a volatile mortgage environment right now. If you look at the spread over the last year, we started in January and the spread's been rising as panic entered the market. And then around June of last year, if you remember, the Fed came out and said, we don't have this under control. We want to reset the housing market. We covered this extensively and we saw panic go up again. And then we come to the end of this past year and we start to see the panic subsiding and folks and experts, economists, the Fed saying maybe the peak of inflation is behind us. So where are mortgage rates going and what are the experts saying? So we've been following the Fed. We've had some positive news coming out with our job reports, with our core inflation numbers, CPI inflation, wage inflation, more positive than was projected by the Fed. So that's good news for us, and it indicates that we will continue to see a slide in interest rates. Although I should warn you, obviously we have the opportunity for those rates to jump up on us again. But if we look what Freddie Mac, NAR, some of the major real estate institutions, what their predictions are, the majority of them are predicting that our rates are going to go down throughout this year as we get control of inflation and things start to mellow out for us.
This is from Lawrence Yoon. The upcoming months should see a return of buyers as mortgage rates appear to have already peaked and have been coming down since mid-November. We've already talked about that, and I want to remind you of that. One of the premier thinkers in the mortgage business, Dave Stevens, who is a former Assistant Secretary of Housing, held positions at the MBA. And he said this, and I think it's very important that we take note of it. So be advised, this may be one of the only windows for the next few years to get into a buyer's market. And remember, as Federal Reserve data shows, home prices only go up and always recover from recessions, no matter how mild or severe. Long-term homeowners should view this market right now as a unique buying opportunity.
This is an opportunity that we haven't seen in the last couple of years. Now, I think there are things that stand in people's ways and the concerns and all that, and I want to address those. But I think if we miss the opportunity, we miss what this market can bring us. One of those current concerns, and we talked about it extensively last month, was home prices. I want to give you a little update on that, the forecasts that are out, and a little perspective on some of the things that we're seeing in this market. So again, you can be confident moving forward. First, the one thing that is true right now about forecasts for home prices, and none of the experts agree, and that's absolutely true. This is a look at forecasts that we follow. They go anywhere from depreciation of 5% to appreciation of 5%. The important thing to remember right now is that we don't see any of those reputable forecasters calling for a free fall in prices in the housing market. And I think you're starting to see a turn in that as well.
One of the interesting things that has been published recently was an article in the Wall Street Journal where they looked at home price appreciation before and after the pandemic. If you look pre pandemic from the fall of 2017 up until the spring of 2020, we saw 12% home price appreciation over 2.5 year time span. If you think about the 2.5 years going into the fall since the beginning of the pandemic, what did we see? A tremendous amount of appreciation across the country in residential real estate, about 38%. So, would it make sense that in some markets and in some cases, we would see a little bit of that come back? Absolutely, it would be. But again, not a free fall in prices like maybe some have said. People in the media, people on YouTube, and other places like that. Another fact that people think about in prices is every home out there is reducing their price right now, and that's simply not true. If you take a look at the share of homes having their price reduced going all the way back to 2021. Now, let's take a look at the graphic right here. At the height of the most recent information we have from Realtor.com in November was just over 1% of these homes having a price reduction in the market. So again, not a free for all, not a situation where we're seeing every home or a great majority of homes having their prices reduced, but it's just a slim piece there.
One of the questions that I would certainly put on the table right now is this question: have home values hit their bottom? This is a look right now at Case-Shiller, FHA, Black Knight, and CoreLogic and their month over month home value change. And if you isolate the last 4 months that have been published, what we see in each case, the depreciation peaked in August. One of the biggest changes that we saw in our market was not a flood of listings, the market like we saw in 2008, but what we saw is a major step back from buyers due to volatility and really just economic uncertainty. We saw listings, active listings, jump substantially. And if we look at those numbers between 2021 and 2022, nationally, our inventory has almost doubled. But if we see the pending listings year over year has decreased on a 12-month view, and that's what's causing part of this correction in our market. It's a supply and demand driven market tempered by interest rates, and we're seeing that in action right now.
All right, so let's take a look at our local market here in Truckee as a whole. We've actually seen price per square foot for single family homes increase 21% since the low back in October. Let's also take a look at inventory. Inventory is down 42% since the high in August. So we only have 103 single family homes for sale right now in all of Truckee. And so we are in a supply and demand driven market like we talked about before, which is keeping our prices, relatively steady, if not increasing.
So we'll also take a look at our Santa Clara inventory and price per square foot just to get a bird's eye view of what's going on there. So our inventory levels have dropped. We've been in the typical seasonality shift where we see inventory lower. So at the peak of our market, our inventory was at about 1,441 homes back in June, and we're actually down to 604 single family homes on our inventory. And as Kelly mentioned, there is a direct correlation between our inventory and price per square foot. So although we are still trending downward on our price per square, where we peaked out sometime in the March timeframe at $964 per square foot, today we're sitting at $846 per square foot, and we're starting to see that trend move sideways as opposed to downward as inventory is low and those interest rates are starting to come down. We'd like to thank everyone for joining us for our State of the Market update here with the Stansell Gaudreau Group. If you have any further questions, do reach out. Kelly and I's information is there on the screen. If you'd like to sit down and do a deep dive on any of these markets nationally or our local markets here, do feel free to reach out to us. Don't forget to like and subscribe. Some chapters here if you'd like to bounce back and forth and review the information, and we appreciate you taking the time. Happy 2023, and we'll see you all next month.